What if the market is underestimating one of the most powerful companies in the world? That is the question hanging over Microsoft right now. The numbers are impossible to ignore. $82.9 billion in quarterly revenue, up 18% year over year. $38.4 billion in operating income, up 20%. Cloud is accelerating. Artificial intelligence is reshaping the way people work, and Microsoft looks stronger than ever. Yet in early May 2026, the stock was trading around $412. So while the company keeps delivering record results, the market still seems cautious. Why? Is this a rare opportunity in a global giant? Or is the market already pricing in risks that many investors still underestimate? In this episode, we will unpack that paradox, look at what is still driving Microsoft, identify the real risks, and answer the big question: is the stock actually undervalued today? To answer that, we first need to understand what Microsoft has become. Microsoft is no longer just the company behind Windows or Office. Today, it is a full-scale global technology ecosystem built around productivity, cloud infrastructure, and personal computing. That includes Office, Microsoft 365, Dynamics, and LinkedIn, as well as Windows, Xbox, Surface, and Bing. Put simply, Microsoft is no longer just a software company. It is a global platform for productivity, infrastructure, and now artificial intelligence. And that is what makes this story so compelling. Microsoft is not just riding the AI wave, it is already turning it into revenue. On one side, there is Azure, which hosts OpenAI's models. On the other, there is Copilot, now being integrated across Office, GitHub, Teams, and other products. The result is clear. Azure grew by 40% this quarter, and more than 20 million paid users have already adopted Microsoft 365 Copilot. This is no longer just a promise. It is already a real engine of growth. After its $13 billion investment in OpenAI in 2023 and 2024, Microsoft now holds roughly 27% of OpenAI, a stake estimated at around $230 billion. It also benefits from an agreement under which OpenAI is expected to buy $250 billion in Azure services by 2032. Altogether, that makes OpenAI a major catalyst for Microsoft, strengthening both its products and its cloud revenue. And this is where Microsoft becomes especially powerful, because beyond growth, there is another factor the market cares deeply about: durability. And by that measure, Microsoft clearly has what Morningstar would call a wide moat. That advantage starts with very high switching costs. The Office and Microsoft 365 suite serves more than 400 million business users. It is deeply woven into daily workflows. Replacing it would be expensive, disruptive, and time-consuming. Then there is the network effect of the broader ecosystem. Microsoft's products connect to one another and reinforce one another. Azure, for example, benefits from the near-universal presence of Windows and Active Directory inside enterprises. Moving to Azure often becomes the easiest path because so much is already integrated. And the more a company uses Microsoft tools, the stronger the lock-in effect becomes. Leave one part of the ecosystem, and you weaken the value of several others. Microsoft also benefits from valuable intangible assets, including patents, a globally recognized brand, and major gaming franchises through Activision Blizzard. On top of that, it has powerful economies of scale through its global data center footprint, which helps lower Azure's unit costs. These competitive barriers have protected Microsoft's profitability for decades, and AI is now adding another layer on top. But even the strongest companies have weak spots. Before we talk about valuation, we need to take a clear look at what could slow Microsoft down over the next few years. The first risk is simple. AI may stay expensive for longer than expected. This is probably the biggest point. Microsoft is in a prime position to benefit from the AI revolution, but staying ahead requires massive spending. In the last quarter alone, the company committed $31.9 billion in capital expenditures, much of it for data centers, AI servers, and advanced processors. And over full year 2026, that figure could reach $190 billion. The strategy is clear. Spend heavily now to capture huge demand later. But the market does not like uncertainty, especially when it comes to the return on that spending. If demand scales smoothly, Microsoft could come out even stronger. But if monetization takes longer or pricing comes under pressure, this investment cycle could weigh on margins and cash flow for much longer than investors expect. The second risk is dependence on OpenAI, combined with rising competition. Microsoft's partnership with OpenAI has pushed it to the front of generative AI. That is a major advantage, but it also creates a form of strategic dependence. If OpenAI slows down, runs into regulatory obstacles, or if the relationship between the two companies changes, Microsoft may need to adjust quickly. At the same time, competitors are investing enormous sums to catch up, and open-source models are improving fast, which could appeal to companies looking for cheaper or more flexible alternatives. So yes, Microsoft has taken the lead, but it will have to defend that lead relentlessly. The third risk is the broader economic environment. Microsoft is diversified, resilient, and global. But no company is completely insulated from a macroeconomic or geopolitical shock. If inflation picks up again, if international tensions disrupt the economy, or if businesses start cutting technology budgets, growth could slow. That would not necessarily be dramatic for Microsoft, but it could still be enough to shift market sentiment, especially at a time when expectations around AI remain very high. And this is where the market reaction starts to make more sense. Why is Microsoft's stock falling when the company looks so strong? Because the market does not reward past performance alone. It prices in the future, and more importantly, the uncertainty around that future. In early May 2026, the stock was trading around $412. Just a few months earlier, excitement around AI had pushed it close to new highs. At that point, the market was pricing in something close to a best-case scenario. Then the questions started to appear. How much will Microsoft need to invest? How long will it take for those investments to turn into cash? And how much pressure could that put on margins? In reality, the stock's decline mostly reflects a shift in mood. The market has moved from pure excitement to a more cautious, more rational phase. And very often, that is when the most interesting opportunities begin to appear. So, to decide whether that caution is justified, we need to look more closely at the numbers. Not just the headline figures, but the ones that reveal the company's real quality underneath. First, economic value creation. To measure that, we compare return on invested capital with the weighted average cost of capital. In simple terms, we want to know whether Microsoft earns more on its investments than those investments cost to finance. Recently, return on invested capital was around 21 to 22%, while the weighted average cost of capital was around 8.5 to 9%. That creates a strongly positive spread of roughly 12 to 13 points. In plain English, every dollar Microsoft invests is creating value. Second, shareholder returns. Microsoft pays a quarterly dividend that has been rising steadily for years, at a pace close to 10% annually. The yield is still modest, around 0.9% at the current share price, but that is largely because the stock remains highly valued. In the second quarter, Microsoft also repurchased about $3.5 billion of its own shares. The message is clear. Part of the profit goes back to shareholders, while a large portion is reinvested to keep growth going. Third, financial strength. On this front, Microsoft stands out. At the end of March 2026, the company held about $78.3 billion in cash and short-term investments, compared with $40.3 billion in gross debt. That is an exceptionally strong balance sheet. Even after accounting for certain data center-related commitments, Microsoft still has one of the healthiest financial positions in the market. Fourth, earnings growth. Over the last 5 years, Microsoft's adjusted earnings per share have grown by about 18% per year on average. More recently, that pace has accelerated to nearly 21% over the last 12 months. So Microsoft is not just highly profitable, it is also growing at a durable pace, and that combination is rare. So what we have here is a company that combines a strong value creation spread with high growth. That clearly puts Microsoft in the category of a value creator. With a 12-point spread and earnings growth of 18 to 21%, Microsoft is creating substantial value for shareholders. Now, let us move to market valuation. At a share price of around $412, Microsoft is trading at roughly 24 times adjusted earnings over the last 12 months. If we look at expected earnings over the next 12 months, that multiple falls to around 21 times. That tells us the market still expects growth, but not in an overly aggressive way. We are no longer in a situation where every part of the future is already priced in, and that is exactly what makes the story interesting. Over the last 5 years, the stock has traded at an average of around 28 times earnings. That suggests the market is valuing Microsoft more cautiously today than it has in recent years. Compared with companies like Oracle, Salesforce, Alphabet, and Apple, Microsoft looks reasonably valued today. The stock is not bargain basement cheap, but it is also not showing obvious signs of excess. And given its growth profile, profitability, and balance sheet quality, that valuation may even look conservative. So the interim conclusion is this. Based on earnings multiples, Microsoft appears fairly valued, and perhaps even slightly undervalued relative to the quality of the business. That alone is not enough to reach a final verdict, but it is already an important signal. Next, let us see what a more fundamental method based on future cash flows has to say. The logic behind a DCF analysis is straightforward. Estimate how much cash Microsoft could generate in the years ahead, then discount that value back to today. It is a demanding method, but for a company of this quality, it is a very useful one. Step 1. Establish a credible starting cash flow. Microsoft generated an exceptional amount of cash in the third quarter of fiscal 2026. But to stay prudent, we need to separate what looks durable from what may be temporarily boosted by the cycle or by short-term effects. After removing the spending required to maintain its industrial and technological base, we arrive at a normalized free cash flow of roughly $135 billion to $140 billion. That becomes the starting point for the projections that follow. Step 2. Map out several growth paths. In the base case scenario, we assume free cash flow grows by around 15% per year for several years before gradually slowing to a more normal long-term pace of around 2.5%. In a more optimistic scenario, we assume stronger annual growth, closer to 22%, with a terminal growth rate slightly above 3%. We then apply a discount rate that matches the company's risk profile to convert those future cash flows into present value. In the base case scenario, that leads to a valuation of around $640 per share. In the optimistic scenario, the valuation rises to around $1,120 per share. Of course, a prudent investor cannot treat the optimistic scenario as a certainty. That is why it makes more sense to give greater weight to the base case. When we do that, we arrive at an average value of roughly $785 per share. And after applying a margin of safety, we get a maximum buy price of around $700. Put simply, at the current price, Microsoft appears to trade well below that cautious estimate. But we should stay realistic. This kind of valuation depends heavily on the assumptions behind it. These figures are not absolute truths. They are reference points designed to structure our thinking. Even so, one conclusion stands out. At the current price, the market seems to be pricing in a lot of caution. We also tested a harsher framework, one that subtracts all current AI expansion spending from starting cash flow, as if that spending would remain permanent over the long term. Under that more conservative version, the maximum buy price falls to around $430. But our view is that once the current expansion phase is behind it, Microsoft will not need to reinvest at that level every single year to protect its position. Finally, let us look at a few possible stock price paths over 1 year, 3 years, and 5 years. The goal is not to predict the future with certainty. It is to visualize what the investment could look like under different market conditions. In a bearish scenario, growth slows sharply, margins come under pressure, and the economy becomes more difficult, with recession risk rising and AI monetization taking longer than expected. In an optimistic scenario, Microsoft exceeds expectations. AI drives a lasting acceleration in earnings growth above 20% per year, and Azure maintains growth near 40% for the next 3 years. In the base case scenario, Microsoft keeps executing well. Cloud stays strong. AI is monetized gradually. Profits continue to grow, and valuation multiples remain reasonable. In that case, the stock could reach around $575 in 1 year, $700 in 3 years, and $850 in 5 years. And the difference in returns is significant. Buying at $412 could produce roughly 15% per year over 5 years, while buying later at $700 could reduce that to roughly 4% per year. That is the power of disciplined entry points. So, in the end, what should we really think about Microsoft? At this stage, the conclusion is fairly clear. Microsoft remains an exceptional business. The company is in excellent health, and it is still growing. Its profit engines remain strong, with operating margins around 46%. And despite the heaviest investment cycle in its history, Microsoft is still creating meaningful economic value while growing earnings per share at roughly 18% per year. Its balance sheet is extremely solid, and solvency risk is close to non-existent. The current market valuation is not demanding, which is unusual for an asset of this quality. Our DCF analysis also suggests that the market may be undervaluing Microsoft, most likely because of caution around the unknowns tied to AI. We estimate a maximum buy price of around $700. So at $412, the stock appears to sit well below that level, with the potential for an attractive return of around 15% per year over 5 years in our base case. Of course, nothing is guaranteed. We still need to watch how AI monetization develops and how macroeconomic risks evolve. But based on the company's fundamentals and long-term outlook, Microsoft appears undervalued today. And that wraps up this analysis of Microsoft. If you found this episode useful, feel free to support the channel with a like, a comment, and of course a subscription, so you do not miss the next analysis. Disclaimer: this content is provided for informational purposes only and does not constitute investment advice. Some parts of this analysis may rely on artificial intelligence tools, and their accuracy cannot be guaranteed. Always do your own research before making a financial decision.